Welcome to your ultimate LECPA cheat code session on double taxation agreements. Look, if you're a second or third year BS accountancy student right now, I know the struggle. Trying to keep these massive tax concepts in your head, it literally feels like downloading a 100 GB update onto a 2 GB hard drive, right? Well, today, we're going to wire your brain to master this topic for the next 3 years. We want you absolutely bulletproof on board exam day. We're using study hacks like chunking and active recall to make sure this stuff actually sticks. Let's dive in.
Here's our mental map for this explainer. We're chunking this massive topic into 6 distinct levels: decoding double taxation, treaty supremacy and conflict rules, relief methods, DTA models, securing relief, and finally, our ultimate LECPA bullet review.
Section 1. Decoding double taxation. Let's build that foundational schema so everything else has a logical place to stick in your memory. So, what actually is a tax treaty? Basically, it's an international cross-border rulebook. It's a formal written agreement between sovereign states designed to make sure a taxpayer doesn't get unfairly bled dry by 2 different governments on the exact same income. I mean, without this, cross-border business would pretty much just grind to a halt. Think of these as the why behind the law. You've got to memorize these 4 pillars right now. Eliminate double taxation, prevent fiscal evasion, promote mutual trade and investment, and accord fair and equitable tax treatment, which we call comity. Every complex tax treaty rule you're going to encounter exists solely to execute one of these specific goals. Moving on to Section 2, Treaty Supremacy and Conflict Rules. This is prime territory for board exam trick questions, so pay close attention. Okay, grab a pen because this Latin phrase is your absolute anchor. Pacta, sunt servanda. Write that down. It basically means the agreeing parties have to comply with their treaty obligations in good faith. The Philippines can't just ignore a treaty when it feels like it. International comity demands good faith compliance. When we sign a treaty, it has the force of law and the government is bound to fulfill it. And because of that good faith principle, we get our general rule. Tax treaties generally prevail over domestic law. If the Philippine tax code says one thing, but a double taxation agreement says another, the treaty generally wins out. But wait, here is the twist. What happens if the domestic law actually provides a lower tax rate than the treaty? This is exactly the kind of exception examiners love to use to catch out students during the LECPA. Boom, there it is. The lower domestic rate prevails. The whole point of these treaties is to relieve the burden on the taxpayer, not increase it. So, if the domestic code gives the taxpayer a cheaper deal, you ignore the treaty and go with the local rate. All right, let's hit Section 3, Relief Methods. Exemption versus credit. How does the math actually work to eliminate that double burden? You've really got to contrast these directly in your mind, because getting them mixed up is a classic rookie mistake. The exemption method focuses entirely on the income itself. The income taxed in the source state is just flat out exempted in your state of residence. On the flip side, the credit method focuses on the tax. The income is still taxable back home, but the tax you already paid abroad gets credited against your local tax bill. So exemption shields the income, while credit shields you from paying the tax twice. And the credit method breaks down even further into 2 types. You've got full credit, where every single cent paid in the source state is fully deducted. But you really need to keep your eyes peeled for ordinary credit problems in your exams. With ordinary credit, the deduction your resident state allows is strictly capped to its own tax appropriate to that income. Simply put, you can't deduct more than what your local government would have charged on that exact same piece of income. Section 4, DTA models. Let's look at the OECD, UN, and US frameworks that dictate how these treaties are drafted in the first place. So let's break down these 3 major models. The OECD model is generally aimed at developed nations, and it heavily favors taxation rights for the country of residence, capping interest to 10%. Then you have the US model, which taxes dividends at 5% or 15%, while royalties and interest are taxable only in the resident state. But for your Philippine tax exams, pay really close attention to the UN model. It targets developing nations and favors the source country's taxing rights. This is huge for the Philippines since we act primarily as a host country for foreign investment. It allows us to keep our taxing rights on income generated right here at home. Okay, almost there. Section 5, Securing Relief through ITAD and CORTT. This is the real-world paperwork you need to know. This is all about the bureaucratic reality of claiming these benefits, and the BIR loves testing updated admin procedures. Under the old system, RMO 72-2010, you had to file a Tax Treaty Relief Application, or TTRA Form 0901, for pretty much all income types. But under the newer system, RMO 8-2017, if you were dealing with dividends, interest, or royalties, memorize that specific trio right now, you no longer file a TTRA. You submit the newly created CORTT form instead. Now here is the exact CORTT procedure, and the absolute most critical factor here is the timeline. Follow this exact flow for the boards. Step 1, the non-resident submits the CORTT to the withholding agent prior to payment. Step 2, the withholding agent pays the taxes. And Step 3, the withholding agent files that CORTT with ITAD and RDO 3D9 strictly within 30 days after the tax payment. Do not miss that 30-day window in your exam scenarios. It is literally a fatal flaw. And obviously, a taxpayer can't just verbally claim they're a foreign resident to get these lower rates. You need the core legal documentation. The absolute non-negotiable here is the Tax Residency Certificate, or TRC, duly issued by the Foreign Tax Authority. You'll also need the applicable BIR form, so either CORTT or TFRTR, and you have to specifically cite the relevant provision of the applicable tax treaty. Finally, Section 6. Our ultimate LECPA bullet review. Let's lock this down. This is your high-retention mental screenshot to lock away in your 3-year memory bank for board exam day. Ready? 1. Pacta sunt servanda means treaties prevail in good faith, unless the domestic tax rate is lower. 2. For relief, exemption targets the income itself, while credit targets the tax bill. 3. For our models, OECD has a residence bias, while the UN has a source bias, which perfectly fits the Philippine setup. And 4, for bureaucracy, CORTT replaces TTRA exclusively for dividends, interests, and royalties. All right, to make sure this really sticks for the next 3 years, let's test your active recall right now. Don't look back at your notes. If a U.S. investor earns royalties in the Philippines and has a TRC, do they file a TTRA or a CORTT? And exactly how many days after tax payment must the Philippine agent file it with ITAD? Answer that out loud right now. If you've got it instantly, you've absolutely mastered the mechanics of Philippine tax treaties. If not, maybe hit rewind and try again, because the Board of Accountancy won't give you a second chance. Thanks for hanging out with me on this explainer. Keep up the amazing studying, and I'll see you next time.